Hey, good morning, everyone. Marty Mazzora here, January 22nd, 2022, with your weekly macro update. Going to do this again via the video, obviously, this week. I will try to keep it brief. I want to end with just a quick technical look at the S&P 500. As you noticed, it was quite the rough week. It's been a very rough month for U.S. stocks in particular so far. And I may come back over the weekend, have lots of charts and data to update our weekly exercises that we didn't really get enough into yesterday as we would have liked to. So going to finish that up over the weekend. And there's a lot of volatility in these markets. I think you're going to see a lot of changes in things like our sentiment indicators and to some degree maybe even our financial stress index. So we'll update those. If I think it's interesting enough, I may come back and share something over the weekend or dribble it out to you during the morning notes next week. So without further ado, this is our chart of our own macro index. Actually rose just a tad this last week after that plunge that we had last week. Let's go through the charts that matter among our 48 data points, or the charts I should say that look interesting enough to share with you today. Starting with mortgage purchase applications, saw quite the bump, interestingly, despite quite the rise in the 30-year average mortgage rate. I think we're up to like 3.64, I believe, is the average. And so this would be, I think we can assume, folks wanting to buy homes, wanting to mortgage new homes, who realize that rates are likely to go even higher, at least they feel that way. So big bump in mortgage apps due to folks kind of rushing to get that interest rate locked in this environment. Housing starts and permits came out last week. They were higher month over month in both cases. However, they were higher for multifamily units and lower for single family housing. Now again, just the headline number is positive, right, and bullish. However, the single family activity is what's considered more important from an economic indicator standpoint. You know, the old saying, higher prices are the cure for higher prices. Well, higher prices does utterly apply to rental properties. The cost of renting a place has gone up exponentially over the last year and continues to be rising. So obviously, developers, investors, and so forth want to take advantage of what apparently they believe is a sustainable rise in rents, and they want to put more units out there. And of course, as supply increases, then we should see a topping out of rent increases as well. Home builder confidence actually ticked down just a little bit, but an 83 is still a high number, and it's off of that 84, and we're well off of that all-time high back here a number of months ago. In terms of the details of the report, prospective buyers traffic gave back a 2-point gain from December. Present conditions were unchanged, and future expectations slipped by 2 points. From the report, quote, while lean existing home inventory and solid buyer demand are supporting the need for new construction, the combination of ongoing increases for building materials, worsening skilled labor shortages, and higher mortgage rates points to declines for housing affordability in 2022. All makes sense given what we know about the overall environment, the cost of materials, labor across industries, frankly. Big month-over-month increase in consumer and industrial loans, so companies are accessing credit in this category, and of course that by itself is a bullish sign for the economy going forward. The economic surprise index for the U.S. came off a little bit further from last week. Now this is updated every day, so it's up a little bit from where it was, but we were at negative 2.6, we're at negative 3.4. Below zero means that the economic data is coming out worse than economists had anticipated. We also look at several other regions, and we look at the whole thing globally. And notice, though, that in the Eurozone, we actually have a positive 40. In Japan, we have a positive 25, call it. China, positive 46. Emerging markets, across emerging markets, positive 19. And the global surprise index is a positive 20. And of course, folks and clients, as you know, that comports with our relative bullishness for non-US equities. With regard to market inflation expectations or inflation sentiment that's illustrated in the market. The Treasury inflation protected securities or TIPS, the break evens, which is a reflection of inflation compensation. It's the spread between a Treasury inflation protected bond versus the regular bond. And on a short-term basis, you can see that the compensation there is 3.2%, which is, a high level of inflation relative to what we've come to see as normal these past few decades. Now, as you go further out the curve, all the way here to the 10-year inflation spread, break even, 2.37, which says that longer term, people think we're going to kind of get back to the norm. And that's very much illustrated here in the five-year inflation swap spread, 2.39%. Now, a lot of people just take this as gospel, if you will, as verbatim. To me, it's market expectations. And of course, they could be right. But we see notable forces, again, that we think will produce inflation at a notably higher clip than that over the next 5 and 10 years. And then here's CPI at an incredibly high 7% currently. And then I think this is my last macro chart, Baltic Dry Index. Wow, what a plunge. This is the cost of shipping, dry bulk commodities mostly across the world's ocean. That could speak to a lot of things globally, but it does say here is to the extent that the BDI was a force pushing inflation higher. Of course, that's dropped here exponentially, about as fast as it rose here. So again, lots of cross currents, lots of mixed global data. For example, if we look at South Korea, its exports so far in January are up 22% year over year. Economists believe that speaks to the rush, ahead of the big Chinese holiday next week. Exports to China were up 19% year over year. But to the US, up 28%, and to the EU by 16% as well. So clearly it's more than just the Chinese New Year. And of course, we had the world's need for computer chips. Those exports were up 30%. Cars were up by 23%. And South Korean imports were up by 38% year over year. Japan's exports for December were up 17.5% year over year. The estimate was for 15.9. Imports jumped by 41%. Japanese inflation rose a little bit. The Chinese economy grew 4% year over year according to their Statistics Bureau. Their estimate was 3.3%. Australia added more jobs than expected in December, and the German ZU index, sentiment index, for January jumped to 51.7 from 29.9. The estimate was for 32. But then, staying with Europe, when we look at the United Kingdom, very high CPI print, 5.4%, and the Bank of England is tightening monetary policy for sure. Retail price index jumped 7.5%. Wages dropped 4 percentage points. Consumer confidence in the United Kingdom was negative 19. The estimate was going to be a negative 15, and so on. So the UK does not share the optimism that's showing up in places like Germany and again in Asia as well. And then French business confidence in January fell 2 points to 107. That's the weakest since April. And again, looks like Omicron is viewed as something that's a big deal there as well in terms of the sentiment. So yeah, mixed results pretty much everywhere. Again, our index did see a slight tick upward. The big story right here, folks, of course, is the market. And we do a ton of work weekly on the market that I'm going to be getting to over the weekend. And so some things will emerge there, no doubt about it, and some of our indicators, as I said earlier. And again, either I'll share some of that with you this weekend or dribble it out to you in the coming couple of weeks on the morning note. And then lastly, and certainly not leastly, let's run through the technicals on the S&P, and then I'll let you go. So just the 1-year daily chart and the written blog, I talked about dropping through the 50-day moving average, plunging through it, I should say. We had a rising wedge that's a bearish pattern. I'll show you the divergences in a minute. 50-day moving average rolling over, very negative technical look. Closing below the 200-day moving average. Yeah, that's kind of an ominous sign right here, folks. I don't know how things are going to wake up on Monday. Next week we do have the Fed meeting. And right now all indications are that they're going to focus on promising to beat up on inflation as opposed to support markets. That could change if the market really continues to plummet going into that meeting. But as of right now, that's not a good technical look, I'll tell you. You're going to get tired of these same old patterns that I keep showing you, but they are what they are. And this is just a very bearish divergence look in both these MACD and RSI indicators. When you have the rising wedge and the bearish divergences, you have the worst of three worlds right there. Breaking down here through this 200-day moving average on top of this again has got people nervous, no ifs, ands, or buts about it. Zeroing in, as we like to do, on the 60-minute and the 120-minute chart. I'll start with the 60-minute, 60-day chart. But I think it was Thursday last week. This was looking pretty positive to me, and so I dared show that to you. We had the falling wedge. We were breaking out of that. And each candle here is 60 minutes, by the way, so this is the hours of the day. And we had nice bullish divergences on the momentum indicators, and those have been working beautifully, as I've been showing you for the last several weeks. Well, that one failed big time, and nothing worse than a failed breakout, and came right back into that wedge. In fact, really, I'd say falling below that wedge right there, right? And as of Friday, we still had what I would consider positive divergence here, but that's been busted through with the MACD as well. Almost with the RSI, but not quite. On the 2-hour chart, it's worse. We have the falling wedge. Okay, that's bullish, but it's bullish when you have bullish divergences. And yeah, you could argue you still kind of do. You still do there with the RSI, but oh my, you do not here on the MACD. This breaks down through here. You get notably below that 20-day moving average. If I was a short-term investor, I might really take a short position on the market, but I'd have my stops to make sure I don't get killed, because again, those dip buyers can come in violently and turn this thing around, at least for a period of time, in a heartbeat. Come to think of it, let me go in the other direction. I promise I'll let you go. So weekly 5-year chart, very important to look at across all time frames. Longer term charts have been holding up fairly well, particularly the monthly. That's rapidly becoming not the case. So we had rising wedge here in the weekly chart as well. So each bar is a week. Breaking below that, you got the 50-week moving average. I'd probably run the 20-week moving average if I wanted to give you something more pertinent to the long-term chart. And of course, it's broken down below there. But this is a very definite sell signal against negative divergences. That's not something you want to see, frankly, right here. Even more importantly, for the long-term investor, it's the monthly charts. So here's a 10-year look on a monthly basis. And again, breaking down below a wedge, and there's a week left in the month, and it's all about where we close, by the way. So this is where we are right now. This is not actionable if a person is trading on the monthly charts. Not actionable unless we get a close below that. We get a January close below that, right? And it's going to have quite the comeback. The market's down about 8% this year so far, and that's the S&P. The NASDAQ is down, double digits for sure. But again, it's not a close, so we want to be cognizant of that. This is not a good look. This is the MACD rolling over, and this is a bearish divergence in the RSI. So folks, these are technical indicators that kind of support the real shaky, I want to say fundamental setup, but when I say that, I hesitate because you saw that our macro index is still nicely in the green. Now we have to put that in the context of the trillions of dollars that got thrown at the economy, and how that has a lot, to say the least, to do with why the macro setup looks okay right here. It also has a lot to do with why inflation doesn't look okay, but remember, longer term, there are some real structural changes going on in our world that are inflationary, beyond the exacerbating of that had to do with the whole COVID situation and continues to. So I think that probably went longer than I anticipated, but let me leave it there and get on to the rest of our updates for the week, and I'll be right back at you very soon. Hope you have a wonderful weekend. Enjoy all that football. Big week there, obviously, and here in California, the weather's beautiful. So have a great one, folks. Thank you as always. Bye-bye.